Welcome to Brain on Books YouTube channel. If you've ever, found yourself staring at a perfect trade setup, maybe everything lines up, but your hand just hovers over the mouse. Total paralysis. Or maybe you've seen a nice little win turn into a huge loss because you just had to squeeze a bit more profit out.
Oh, yeah. That feeling.
Then you know exactly what we're digging into today. We often think trading is all technicals, right? Charts, indicators, the perfect entry formula.
That's the common view, definitely.
But the real struggle, the thing that keeps so many traders inconsistent, it's the mindset. It's what's going on up here.
It really is the gap, isn't it? You could have the best strategy on paper, maybe something that wins 90% of the time at backtesting. But if your own mind only lets you execute it properly, say 40% of the time when real money's on the line, well, the strategy itself becomes almost meaningless.
Exactly. People focus so much on the market dynamics.
They do. Hours and hours on analysis. But they ignore the main thing controlling their results, their own thinking, their own emotional reactions. Have you ever found yourself maybe taking trades just because you're bored? Or going on tilt after a bad run, trying to win it back?
Revenge trading, yeah.
Or maybe letting that overconfidence after a few wins completely blow up your risk management. That right there is the mental game. And often, for inconsistent traders, the mental game is winning.
Which is precisely why we're doing this deep dive today. We're focusing on Jared Tendler's fantastic book, The Mental Game of Trading. And look, this isn't just some armchair theory. Tendler built this framework working with the best. We're talking professional traders, sure, but also elite poker players. I mean, talk about psychological pressure.
Poker players arguably face even more intense mental battles in some ways.
And top athletes, too. He took the kind of systematic psychology that helps people win World Series rings or Olympic medals and applied it directly to the trading arena. It's practical.
And our mission today, really, is to give you a clear path into that system. This isn't about rah-rah motivation or just positive thinking.
No feel-good fluff here.
No. This is a proven step-by-step process. It's designed specifically to help you identify and overcome those classic mental roadblocks we all face. Fear, greed, overconfidence, and maybe the most destructive one, tilt.
We're going to break down how you can stop just reacting impulsively to whatever the market throws at you.
And start mapping your specific emotional patterns. Then systematically training your mind for better decisions, especially when things get stressful, when the market is really testing you.
Okay, let's jump into the foundation first, because this idea, it really turns conventional trading wisdom on its head, doesn't it?
It absolutely does.
The standard advice you always hear is control your emotions, suppress them, trade like a robot. But Tendler argues that trying to suppress them is actually the core problem.
That's precisely where the breakdown happens. You can't just switch off being human. It's impossible.
Right.
But what you can do is change your relationship with those emotions. Tendler's core point is emotions are just signals.
Signals, okay.
Yeah, they're like little indicator lights on your dashboard.
Yeah.
They're trying to tell you something important about what you're doing right now, or maybe your risk exposure, or even a flaw in your strategy that your logical brain hasn't quite caught on to yet.
Okay, let's use that analogy from the book, the hot stove one. I think that makes it really clear.
Perfect example.
So if you accidentally touch a hot stove, right, your body doesn't sit there and rationally analyze the metal's temperature or calculate the potential burn damage.
No, there's no time for that analysis.
Exactly. It's instant. Your body triggers a reaction pain, right, followed by a reflex to pull your hand away. It's a signal designed purely to prevent further damage.
And that immediate signal is all about self-preservation. That's how we need to start treating our trading emotions. Not as the enemy to be crushed, but as that warning light flashing on the dashboard.
Okay, so how does that signal idea work when you're actually trading, let's say, fear? You're looking at a setup, it meets all your rules, but you just feel this knot of anxiety.
Right, the common reaction is to tell yourself, just push through it, be disciplined, take the trade. But Tendler says, hang on, that fear isn't necessarily irrational. It might be a signal.
A signal for what, though?
It might be signaling that, hey, maybe you're actually risking too much capital on this one trade relative to your account size. Or perhaps, deep down, you haven't fully accepted the probabilities involved in your strategy. Maybe past losses are still haunting you.
So the question isn't, how do I stop being afraid?
Exactly. The real question is, what is this fear trying to tell me about my preparation, my risk management, or my underlying beliefs about this trade?
That completely shifts the focus, doesn't it? It's not an internal failing, necessarily. It could be pointing to a structural issue in your approach.
Precisely. Or take frustration. You have a losing trade, maybe a string of them, and you feel that anger rising.
We've all been there.
Of course. The temptation is to blame the market, right? It's rigged, or market makers hunted my stop. But that frustration signal, it's probably not about external unfairness.
So what's it signaling then?
It might be signaling that actually you broke your rules. Maybe you traded outside your plan because you felt bored and just wanted action. Or perhaps you ignored a key exit signal because you were distracted or greedy. The frustration is like a big flashing arrow pointing directly at the part of your own process that broke down.
Okay, this makes sense. And if emotions are signals pointing to process flaws, then just relying on willpower to manage them, well, that seems like a losing battle.
It is. Willpower is a finite resource. It runs out, especially under stress. Discipline, on the other hand, is systemic. The best traders don't rely on being strong in the moment. They have predefined rules and systems that dictate their actions when those emotional signals start flashing.
And that's where Tendler's system comes in. He provides a structure, and it seems like it offers 3 huge benefits. First, it helps you take that chaotic mess of feelings and turn it into something you can actually track.
Data points, right?
Exactly. You can't fix what you don't measure. If you just say, I get emotional, that's useless. But if you can say, I feel FOMO specifically after missing the first move on high volume days, now you have something concrete to work with.
Right. And the second benefit seems to be shifting focus to the root cause.
Yes. This is critical. If you just try to manage your anger after a loss by, say, taking deep breaths, you're only treating the symptom. The anger will keep coming back.
Because you haven't fixed the source.
Correct. Tendler wants you to dig deeper. Why does that loss make you angry? Is it because you secretly believe you should win every trade? Is it tying your self-worth to your P&L? Fix that underlying issue, and the anger signal itself starts to fade naturally over time.
Okay, and the third benefit is building that structured approach before the heat is on. Absolutely. You need rules for emotional risk management, developed when you're calm and rational. Think of it like an emergency checklist for pilots. They don't figure out what to do during the emergency. They follow predefined procedures. Your emotional management plan does the same thing. It overrides the impulsive emotional brain when things get volatile.
All right, so we accept emotions are signals. The next logical step is actually mapping those signals. Chapter 2 dives into building what Tendler calls a mental blueprint. It's about understanding your personal pattern of emotional reactions.
Yeah, this is crucial because many traders think their mistakes are just random bad luck, or maybe one-offs, especially if they've had a winning streak recently.
Right, that wasn't like me.
Exactly.
Yeah.
But Tendler shows that almost always these mistakes are cyclical. They're predictable if you look closely enough. Mapping your pattern takes, honestly, ruthless self-awareness and some systematic tracking. No sugarcoating.
Let's walk through the steps for someone listening. How do you actually build this map? Step 1 is identifying the triggers.
Right. Step 1, identify triggers.
Yeah.
You have to become a detective about your own behavior. What specific situations reliably cause that emotional flare-up? Is it when a trade immediately goes against you, maybe hitting 50% of your stop loss triggers panic?
Or could it be something else, like just boredom? Market's flat, nothing's happening.
Absolutely. Boredom is a huge trigger for impulsive, low-quality trades. Or maybe it's the flip side, euphoria. You hit 3 winners in a row, and suddenly you feel invincible, reckless. That's a trigger, too. You need to know what sparks the fire.
Okay, so you identify the spark. Then step 2, track responses. And this isn't just noting, I got mad.
No, you need more detail. Way more. You have to document the whole emotional journey. What exactly did you feel? Was it anxiety? Was it that jittery excitement, deep regret? And critically, how did that feeling physically and mentally impact your decisions?
Like, did your heart start racing? Did you find yourself hesitating, moving your stop further away?
Or do you slam the buy button on a revenge trade way outside your rules? You need that level of granularity. Write it down immediately after the trade if possible.
Got it. Then, step 3, look for patterns. This is where the blueprint really starts to take shape, right? After you've collected this data for a while.
Exactly. Maybe after a few weeks or a month of honest journaling, patterns jump out. You might see, wow, I always seem to add to losing positions after 2 consecutive losses. Or every single time I have a really big winning day, the next day I give back half of it through overconfidence.
And this helps define your specific flaw profile, so to speak. Tendler contrasts the hesitant trader, always stuck in analysis paralysis, afraid to pull the trigger.
Yeah, right, anchored by fear.
Versus the impulsive trader, who's maybe driven by FOMO or boredom, constantly jumping in and out without a solid plan. Both are operating on these flawed but totally predictable emotional blueprints.
And recognizing that predictable pattern is the bridge to chapter 3, which is all about finding the root cause. Because the emotion itself, the hesitation or the impulse, that's just the symptom.
Right, the surface issue.
We need to dig deeper. What's underneath that symptom? It's rarely just, oh, I need more discipline. It's usually something more fundamental.
And Tendler points out these common learning pitfalls that actually slow traders down. It's easy to fall into one of two extremes.
Yeah, the first is obsessing only over your strengths. The trader who's technically brilliant, great at analysis, but completely ignores their crippling impatience or their tendency to blow up after losses. They keep polishing the shiny parts and ignore the rust.
And the other extreme.
Constantly focusing only on weaknesses, beating yourself up relentlessly for every mistake until you lose all confidence, even in the things you actually do well. Neither approach works.
So we need balance. Which brings us to this core metaphor Tendler uses, the inchworm concept. Can you break that down? I think it's really powerful.
It really is. Imagine an inchworm moving. It has a front end and a back end, right?
Okay.
The front end represents your A game, your peak performance, your best skills, that state where you execute your strategy flawlessly. That's the part that stretches forward.
Got it. Your best self as a trader.
Exactly. Now, the back end represents your C game, your worst habits, your emotional weaknesses, those discipline breakdowns, the recurring mistakes.
Okay, the part that lags behind.
Right. Now, how does the inchworm move? It stretches the front end forward, then it has to consciously pull the back end up to meet it. If it only stretches the front end, it gets stuck.
Ah, I see. So improvement isn't just about getting better at your strengths, pushing the front end.
That's only half the battle.
Yeah.
True. Sustainable improvement requires dedicating systematic effort to pulling that back end forward, too. You have to address those C game issues, those fundamental weaknesses.
So if I keep learning new entry techniques, front end, but I don't fix my habit of revenge trading after losses, back end.
That back end problem acts like an anchor. It holds your entire performance back no matter how good your entries get. You can't consistently perform at your best if your worst habits keep dragging you down.
So the back end, that's where those subconscious fears and biases live.
Precisely. Those are the anchors, the things that prevent your A game from being your average game. So let's say your recurring mistake is cutting winning trades way too early. The symptom is the early exit.
Okay.
But the anchor, the root cause you need to pull forward with the inchworm, might be the trauma from a huge unexpected loss you took 6 months ago. That experience might have created a deep-seated fear of giving back profits, and now your brain automatically triggers an early exit just to lock something in, completely overriding your rational plan.
Wow. So you're basically fighting ghosts from the past without even realizing it. I might think the solution is just practice holding winners longer.
But the real work, the back-end work, might be processing that past trauma and rebuilding trust in your ability to manage risk so the fear signal doesn't hijack your decisions anymore.
That's a much deeper level of work.
It is, but it's necessary. If you don't address those anchors, those back-end problems, they'll just keep showing up, maybe in slightly different ways, but they'll cap your potential. The inchworm forces you to confront the weak link. It ensures your improvement is structural, deep, not just superficial.
Okay, so we've mapped our patterns. We understand the need to find the root cause using the inchworm idea. Now let's tackle the big 3 roadblocks head on. These are the emotional states Tendler focuses on: greed, fear, and tilt. Let's start with greed, which seems like it can cause catastrophic damage really fast.
It absolutely can. And Chapter 4 really dissects it. Greed in trading isn't just wanting more money. It's way more complex than that.
What's driving it then, according to Tendler?
Often it's rooted in deeper needs, like a desperate need for certainty. You want that guarantee the trade will keep going your way, so you push it, hold too long, add too much size. There's also FOMO, the fear of missing out on even bigger potential gains.
And you mentioned validation earlier, too.
Yes, that's huge. The need for validation. Deep down, the trader might feel that only a massive oversized win will finally prove they're actually good at this. That they've cracked the code.
Which ties directly into the ego, right? And this idea of the illusion of control. After a few wins, you start thinking you've figured the market out.
Exactly. I'm on fire. I can't lose. That illusion is incredibly dangerous because it leads to very specific, destructive behaviors that traders often don't even recognize as greed until it's way too late.
What are the common signs we should be looking for?
Overtrading is a big one. Maybe your plan says max 3 trades a day where you hit your daily profit target. But you feel good, you're in the zone, so you keep going, forcing trades that aren't really there. You're sacrificing long-term consistency for that immediate extra hit.
Or the opposite side of that coin, holding winners too long. Your plan says take profit at RR 1.2, the target gets hit, but greed whispers, maybe it'll go to 1.5.
Right. Even if the charts are screaming reversal, you hang on, hoping for that home run. And then you watch helplessly as it reverses, turning a solid winner into maybe break even or even a loss. Painful.
And probably the most dangerous sign.
Ignoring the trading plan entirely, especially with position sizing. Your rule is risk 1% per trade. But after a winning streak, fueled by greed and that illusion of control, you suddenly decide to risk 5%, maybe 10% on the next sure thing.
Because I'm hot right now.
Yep. And that one oversized, emotionally driven trade is often the one that wipes out weeks, maybe even months of careful, disciplined work.
So digging deeper again, what are the root causes Tendler identifies for this kind of behavior?
Several key ones. The scarcity mindset often plays a role, this underlying belief that opportunities are rare and money is hard to come by, so you must grab every single possible cent right now before it disappears.
That sounds like it creates a lot of pressure.
It does. And it pairs really dangerously with the need for quick success, that impatience we see everywhere. People want results yesterday. Then there's the potential for dopamine addiction. The actual thrill of winning, that chemical rush, can become more important than the strategic process itself.
Turning trading into gambling, essentially.
Basically, yes. And finally, overlaying all of this is often an overinflated ego, where your self-worth gets completely tangled up with your P&L. Every win proves you're smart. Every loss feels like a personal failure. That's a recipe for disaster when greed takes hold.
Okay, so that's greed, the destructive drive for more. Now let's flip to the other side. Fear, Chapter 5. If greed makes you reckless, fear makes you freeze.
Exactly. Fear is that primal protective mechanism, designed to keep us safe from physical threats. But in trading, where risk is inherent and necessary, that same mechanism completely backfires. It leads to paralysis and avoidance.
What triggers it in a trading context?
The obvious one is the fundamental uncertainty of the market. Nobody knows for sure what's going to happen next. This is amplified by past trauma. Maybe a big unexpected loss that shattered your confidence months or years ago. And often it's also about ego protection. We hate being wrong, and taking a trade means risking being wrong publicly, even if only to ourselves.
So how does this fear actually show up in someone's day-to-day trading? What are the subtle signs?
They can be insidious because you can easily rationalize them. The classic is hesitating to enter. You see your perfect A+ setup, checks all the boxes, but you just wait. You second guess, and then you watch it take off without you.
Infuriating.
Totally. Another big one is cutting winning trades too early. As soon as a trade goes into profit, the fear of it reversing and turning into a loss becomes unbearable. So you snatch a tiny profit, missing the bulk of the move your strategy was designed to capture.
You mentioned trading too small earlier as well.
Yes, that's a key fear response. You're so afraid of losing that you reduce your position size to almost nothing. The problem is, even when you do win, the profits are so small they barely move the needle. It prevents you from ever reaching your goals, reinforcing the fear cycle.
Tendler breaks fear down into different types, which I found really helpful for diagnosis. Let's go through those 4.
Good idea. First up is fear of missing out, FOMO. Now, this one's interesting because it's actually a blend of fear and greed.
How so?
The fear is missing the big move everyone else seems to be catching. That fear triggers the greed impulse to jump in late, chasing the price, usually at a terrible entry point, long after the low-risk opportunity has passed.
So what's the fix for FOMO?
It's largely mental reframing. You have to constantly remind yourself that the market generates new opportunities every single day. Your job isn't to catch every move, it's to execute your high-probability setups when they appear according to your plan. Missing one move is irrelevant if you catch the next valid one.
Okay. Type 2 is the straightforward fear of losing.
This is the most common one, probably, since losses are an inevitable part of any trading strategy with an edge.
Right. No system wins 100% of the time.
Exactly. But this fear makes traders treat every potential loss as a catastrophe. It leads to micromanaging trades, moving stop losses closer prematurely, or just avoiding taking valid setups altogether after a recent loss.
And the fix here?
Acceptance. You have to internalize that losses are just the cost of doing business in a probabilistic environment. They're like paying rent or software fees. Shift your entire focus from the outcome of any single trade to the consistent execution of your process over many trades. If you followed your rules, a losing trade is just statistical noise, not a failure.
Makes sense. Third type, fear of mistakes, which Tendler links strongly to perfectionism.
Yes, this is a big one for analytical types. The perfectionist trader can't tolerate being wrong. Every small mistake feels like proof that their strategy is flawed or that they are flawed. This leads to endless overanalysis, analysis paralysis, and constant strategy hopping.
Always searching for that holy grail system that never loses.
Which doesn't exist. The fix here is embracing mistakes as essential learning opportunities. You cannot improve without making errors and analyzing them. Focus on iteration and getting statistically better over time, not on being perfect on every single trade.
And the last one, which feels heavy, fear of failure.
This one often goes beyond just the trading account. It's tied to your identity, your self-worth. Maybe you feel pressure to prove yourself to family or friends, or you've told everyone you're going to be a successful trader. Failure isn't just losing money. It feels like a fundamental failure as a person.
That creates immense pressure.
Unbelievable pressure. It leads to terrible decision-making. The fix requires detaching your sense of self-worth from your trading results. Your value isn't determined by your P&L. Focus on the process of learning, on disciplined execution, on becoming a better decision-maker. True failure, in Tendler's view, isn't losing a trade. It's quitting the process of improvement.
Okay, powerful stuff. We've covered the insidious nature of greed and the paralyzing effects of fear. Now let's get into Chapter 6. Tilt. This feels like the most explosive one, the state where all logic goes out the window.
It often is. Tilt is basically emotional overload leading to catastrophic decisions. It's that state of intense frustration or anger where you essentially go to war with the market. It's triggered by some kind of perceived injustice or frustration reaching a boiling point.
Like what kind of triggers?
Could be a bad beat, a trade that looked perfect gets stopped out by a sudden news spike. Could be a string of unavoidable losses. Could be watching a massive winner unfold after you hesitated and missed the entry due to fear. Whatever the trigger, the rational brain basically shuts off.
And the emotional brain takes the wheel.
Completely. And it demands immediate action, usually reckless action, to fix the perceived wrong or recoup the loss instantly. It's an emotional rebellion against the reality of the market.
What are the absolute red flags that scream, I'm on tilt?
They're usually pretty obvious, though hard to admit in the moment. Revenge trading is number one. Immediately jumping back into the market after a loss, often doubling or tripling your size, just to get your money back. You're trading out of anger, not strategy.
What else?
Completely ignoring your trading plan, taking setups that violate every single rule you have, trading instruments you don't normally trade, just clicking buttons impulsively. And often, emotional outbursts, maybe yelling at the screen, blaming your broker, blaming algorithms, blaming the news, anything but taking responsibility.
But Tendler also highlights some more subtle forms of tilt, right? Like injustice tilt?
Yes, and this one is really insidious. It happens when you feel you did everything perfectly right, followed the plan to the letter, great risk management, textbook setup, and the trade still fails, maybe due to randomness or an unpredictable event.
So you feel cheated.
Exactly. You feel the market is unfair or even rigged against you. I deserve to win that trade. This sense of injustice is toxic because it implies the market owes you something.
Which leads to
abandoning your probabilistic approach. If the market is unfair, why follow rules? You start trying to force wins, taking bigger risks, holding losers longer, convinced the market has to pay you back eventually. The antidote here is radical acceptance of randomness. Trading outcomes are probabilistic, especially in the short term. A perfect process can still lead to a loss. You have to decouple your execution quality from the immediate result. Stop seeking fairness. Seek consistent application of your edge.
And the other subtle one is entitlement tilt.
This is the dangerous belief that because you've put in the hard work hours of backtesting, early mornings, studying charts you therefore deserve to win, you feel entitled to profits.
But the market doesn't care about your effort level.
Not one bit. Effort is necessary, but it doesn't guarantee results on any given day or week. This entitlement leads to huge frustration and resentment when the market doesn't deliver according to your expectations, which fuels further tilt.
Humility seems key here.
Absolutely. You need a results-based mindset grounded in reality.
Right.
Respect the risk. Understand that your job is disciplined execution, not demanding rewards.
Okay, so if someone listening feels that anger rising, that urge to revenge trade, what's the immediate practical strategy Tendler suggests to stop tilt in its tracks?
It's the tilt check. This needs to become an automatic reflex before placing any trade when you feel stressed or emotional. Ask yourself point blank, am I calm right now? Am I about to take this trade based on my written strategy, or is this purely emotion talking?
And if the answer is emotion?
The only acceptable action is to step away. Close the platform, walk away from the screen, do not trade. This has to be combined with a non-negotiable hard daily loss limit. Once that predetermined limit is hit, trading stops for the day. Period. No exceptions. You need that circuit breaker.
All right, that covers the big destructive emotions.
Ugh.
Now let's shift gears and talk about building the positive foundations, confidence and discipline. Chapter 7 tackles confidence, which, as you said, isn't about feeling certain you'll win.
Exactly. True trading confidence, the kind that lasts, is stability. It's a deep-seated trust in your tested process and your ability to execute it consistently, regardless of whether the last trade was a winner or a loser.
So a confident trader isn't fazed by a single loss?
Not fundamentally. They understand losses are part of the game, baked into the statistics of their edge. One loss, or even a few, doesn't shake their belief in the long-term profitability of their system if they stick to it. Certainty, on the other hand, is expecting every trade to work.
And that leads to problems. We have the danger of overconfidence.
Right, where you feel invincible, start ignoring your stop losses, maybe get sloppy with analysis because you think you've cracked it. Very dangerous.
And the flip side, lack of confidence.
Which leads to that paralysis we talked about with fear, constant second-guessing, needing validation from others, unable to trust your own analysis even when it's solid.
So how do we cultivate that stable, realistic confidence?
The key is shifting your focus entirely away from short-term results and onto quality of execution. Start grading yourself based on how well you followed your plan, not on how much money you made or lost on a given trade.
So celebrate following the rules, even on a losing trade.
Absolutely. Positively reinforce disciplined behavior. Did you stick to your entry rules? Did you manage risk correctly? Did you take the exit signal without hesitation? That's a win, regardless of the outcome. This slowly detaches your self-worth and confidence from the market's inherent randomness.
But confidence is fragile, isn't it? Tendler talks about cognitive biases that undermine it.
Constantly. Biases are always working against us. Perfectionism, as we discussed, means one mistake can shatter your confidence entirely. Desperation, especially after losses, makes you feel you have to win the next trade, leading to terrible pressure and poor choices.
And what about hope?
Hope and wishing. Probably the most passive but deadly bias. Holding on to a losing trade, hoping it will turn around, ignoring all the objective signals telling you to cut it. That's not confidence. It's avoiding reality. Building real confidence requires actively fighting these biases every day.
Okay, confidence is about stable trust in process. Now, Chapter 8, discipline. This feels like the bedrock everything else is built on, but again, Tendler says it's not about willpower.
Exactly. Discipline isn't about forcing yourself to do the right thing through sheer mental strength. That's unreliable. True discipline comes from building robust systems and routines that make following your plan the path of least resistance. The system does the heavy lifting, not your willpower.
So when discipline breaks down, what does that look like in practice? What are the common problems?
We see recurring themes. Impatience is a huge one, jumping into trades before your signal fully forms, or closing winners way too early out of anxiety. Boredom trading, forcing trades when the market is dead quiet just because you feel you should be doing something.
I can relate to that one.
Many can. Another big one is being overly results-oriented. Constantly checking your P&L, judging your entire day's worth based on whether you're up or down, instead of focusing on whether you executed your plan correctly. That focus on outcome undermines discipline.
So how do we diagnose and fix these discipline leaks? Tendler suggests mapping them with a discipline scorecard. How does that work?
It's about daily, honest self-assessment. At the end of each trading day, you literally score yourself on adherence to your key rules. Use a simple scale, maybe 1 to 5. Did I follow my entry checklist perfectly? Score 45. Did I stick to my predefined position size? Score 55. Did I respect my max loss limit? Score 35 to 1 trade after hitting it.
So it gives you objective data on where the leaks are.
Precisely. Instead of vaguely feeling I wasn't disciplined today, you can pinpoint exactly where the breakdown occurred. Was it entries, risk management, exits? This allows you to target your improvement efforts effectively.
And improvement comes from building better routines.
Yes. Routines automate good behavior. A strict pre-trade routine is essential. Reviewing your plan, checking news, setting risk parameters, maybe even visualizing perfect execution before the market opens. This primes your mind for discipline.
And after the market closes.
An equally rigorous post-trade review. Journaling not just what happened, but why. Why did you deviate from the plan? What emotion was present? What was the trigger? This reflection closes the feedback loop and helps you build stronger habits for the next session. Strict risk management, like always using stop losses, becomes part of that routine, non-negotiable.
Okay, this provides a really solid framework, but what happens when you're doing all this work, mapping, journaling, routines, and you still find yourself repeating the same mistakes? Chapter 9 talks about the malfunctioning mind. Why is it so hard to break bad habits?
It comes down to brain wiring, essentially. Those bad habits, like chasing losses or jumping in too early, become deeply ingrained neural pathways. Your emotional brain, the part seeking immediate relief from discomfort, like the pain of a loss or the anxiety of missing out, reacts much, much faster than your rational planning brain.
So the impulse happens before you can even think about it consciously.
Pretty much. You feel the FOMO, you click buy, then maybe 2 seconds later your rational brain kicks in and says, wait, that wasn't in the plan. But the damage is already done. You're trying to use conscious thought to override an almost automatic subconscious reaction.
Which, as we said, rarely works consistently under pressure. So the key has to be interrupting that automatic loop before the impulsive action happens. Tendler lays out a real-time strategy for this. This seems incredibly valuable.
It's the core of the practical application. This is how you fight back in the moment. Step 1, recognize your triggers. This goes back to your mapping work. You must know from your journal what specific situations put you at high risk for a particular mistake. For example, I know that after 2 consecutive large losses, my trigger for revenge trading is very high. Awareness is the first line of defense.
Okay, so you feel the trigger situation arising. What's step 2?
Step 2, pause and reset. This is critical. You have to create a space between the trigger and your habitual reaction. Tendler recommends a mandatory 5-second pause. Literally count to 5 before you touch the mouse or keyboard. And crucially, don't just pause silently. Say the emotion and the intended plan out loud.
Say it out loud. Why?
Because vocalizing it engages your rational brain. You might say, okay, I feel intense FOMO right now because that stock is moving without me. My plan says I must wait for a pullback entry. Saying it breaks the emotional trance and forces conscious thought into the gap.
That makes sense. It makes it real. So you've paused. You've named the demon. What's step 3? Use a real-time correction plan.
This is where you substitute a constructive action for the destructive habit. You need pre-planned responses for your specific weaknesses. So, if your trigger is revenge trading after a loss, your correction plan might be, if I feel the urge to revenge trade, I will immediately reduce my position size by 75% for the next trade. Or, I will close my platform for 15 minutes and review my trading rules.
So you're not just stopping the bad habit, you're replacing it with a predefined positive action.
Exactly. You're redirecting the impulse. Instead of the automatic destructive reaction, you follow your pre-written, rational emergency procedure. Over time, with repetition, this new pathway becomes more automatic.
That sounds like hard work initially, forcing that pause and correction.
It is. It requires conscious effort at first. But the goal is to make disciplined execution the automatic response, not something you have to wrestle with every time. Your routines are what build this automaticity.
Which reinforces the importance of those pre- and post-trading routines we talked about.
Absolutely. The pre-trading routine sets the stage. You're not just looking at charts, you're setting mental intentions. Today, my goal is 100% adherence to my entry rules. The post-trading routine is where the learning solidifies, journaling the why behind decisions, celebrating discipline, even on losing days, and planning specific adjustments for tomorrow based on today's performance. It's a continuous improvement cycle driven by routine.
Okay, but let's be realistic. Even with a great system, progress isn't always linear. Chapter 10 addresses troubleshooting when you feel stuck or like things aren't improving. What about that common feeling that things get worse before they get better? Why does that happen?
It's a very common experience when you start doing this deep mental work. Basically, awareness doesn't immediately equal control. When you first shine a spotlight on a deeply ingrained bad habit, like impatience, you become acutely aware of every time you feel impatient. It can feel like you're getting more impatient.
Even though you were probably just as impatient before, but less aware of it?
Precisely. Plus, your brain actively resists change. It prefers the old, familiar, even if faulty pathways. Making these changes requires significant mental energy, and there's often a temporary dip in performance as you wrestle with implementing the new behaviors. You need patience and trust that the work is making a difference, even if it doesn't feel like it day to day.
That's reassuring. What about burnout and mental load? Trading is incredibly draining mentally.
Hugely so. Signs of burnout are pretty clear. Chronic mental fatigue, feeling cynical or resentful towards trading, making silly, careless mistakes you wouldn't normally make. maybe physical symptoms too.
What's the fix? Just push through.
Absolutely not. That just digs the hole deeper. The fix is mandated rest and recovery. Take a complete break from the screen today, a few days, maybe even a week. Reduce your trading hours or frequency. Adjust your expectations. You simply cannot perform at your peak when you're mentally exhausted. Recovery is part of the process.
Another issue, especially today with so much information, the bloated brain.
Oh yeah. Information overload. Constantly consuming trading news, following dozens of Twitter gurus, trying out every new indicator. It leads to decision paralysis. You second-guess everything, jump from one strategy to another, never mastering anything.
Sounds familiar. The solution.
Radical simplification. Ruthlessly cut down your information intake. Choose one tested strategy and focus solely on executing it flawlessly. Stop chasing novelty. Master your chosen edge through repetition, not by constantly adding more complexity.
And finally, Tendler acknowledges something really important. Life stress. Stuff outside trading that impacts your performance.
It's unavoidable. A crisis at home, health problems, financial worries outside of trading, these things drain your mental bandwidth and emotional resilience.
Yeah.
You cannot compartmentalize perfectly. Stress will bleed into your trading.
So what do? Pretend it's not happening?
No, you have to acknowledge it and adjust. Recognize when you are compromised. During periods of high external stress, your decision-making will be impaired. The responsible professional thing to do is to significantly reduce your position size, trade less frequently, or even step away entirely until things stabilize. Trying to trade your normal size and frequency when you're under immense life stress is just asking for trouble. Your trading reflects your overall mental state.
That's a really comprehensive look at the mental challenges in the system to overcome them. So wrapping this deep dive up, what's the single biggest takeaway for someone listening?
For me, the core insight from Tendler is this. The mental game isn't some innate talent you either have or don't have. It is absolutely a skill that can be learned, practiced, and mastered through systematic effort, just like learning technical analysis or risk management.
It's trainable.
Exactly. And that ability to execute your plan calmly and consistently, especially when things get tough, that is your true competitive advantage in the long run. Way more than finding the next perfect indicator.
So the call to action is really, stop looking for external fixes.
Pretty much. Stop hoping a new strategy will magically solve your emotional issues. Start doing the internal work. Keep tracking those triggers and emotional responses. Be brutally honest with your discipline scorecard. Use that interim concept to actively work on pulling up those back-end weaknesses, those deep-seated fears or habits holding you back.
And accept that it's a process.
It's all about resilience. Trusting the process, sticking with the system, even when progress feels slow, even when you have setbacks. That's how you build that mental edge.
The market really does test your mental fortitude every single day, doesn't it?
Every single day. But here's the final thought I'd leave people with. The traders who ultimately succeed long-term aren't necessarily the ones with the most complex strategies. They're the ones who commit to mastering themselves. They do the uncomfortable work of tracking their flaws and systematically improving their decision-making under pressure.
And the payoff goes beyond trading.
Absolutely. If you truly commit to mastering your mental game in trading, you won't just become a more consistent and profitable trader. You'll become a fundamentally stronger, more disciplined, more self-aware person in every single area of your life. That's the real prize. If you want to listen to a detailed summary of more finance-related books, then hit that subscribe button now.